Here are some single resource examples on one of the biggest decisions that we make in our lives, real estate. Many of us at some point in our life will be faced with some kind of real estate decision to make. It can be anything from do we rent, do we buy, what kind of payments do we set up, do we refinance, do we pay off, and do we sell versus rent it out? These are all big decisions, often with long-term commitments, with big financial impact to our lives. Yet often these decisions are made without truly understanding the real numbers and the real impact of each choice. It doesn't matter if you just graduated and you're off to your first adult job, or if you're retiring and relocating, these same decision principles still apply. I'm going to use the best estimates quickly available to me, so don't expect fraction of a penny accuracy. Focus on the process, the decisions we're making, and so that you understand the kind of questions to ask and the numbers to research for your particular case when you come to that point. Let's start by saying we've already decided to buy a house. Even beyond that, there are a lot of ways to purchase a house. So how do we know which is the best way to buy it? There are a ton of variables that can exist when choosing a house. So let's just say that you've already picked out your basic constraints. These can be things like how many bedrooms, the zip code, whether you need a garage or not, the school districts. And for the purpose of this exercise, let's just say the house that meets the basic constraints you've established is around $350,000 to buy it. For option one, let's model a cash purchase. Now, $350,000 might be the price of the house, but what other costs are associated with that? A quick research says that the seller pays the realty fees, so we don't have to worry about that. Another website shows that we have up to 3% in closing costs, even with a cash purchase. So let's model that in here. So now that we have the extreme in option one of paying cash, let's do the other extreme of putting as minimum down as we can. So for a 30-year fixed rate conventional loan, let's say that's 5% down as the minimum. The easiest way to do the math is to just use an online mortgage calculator like this one. So I'm going to enter in the basic data of the $350,000 and the 30-year term. Now, as we look through the mortgage details, we see that there are things like property tax and insurance on the house. Well, those are going to apply whether we paid cash or not. So to make sure this is a fair comparison, we want to add those things back into option one as well. In my life, I haven't noticed as much inflation on things like property tax, especially if you get an attorney to go in there and try to negotiate every year. So even though we normally want to include inflation, I'm going to just leave these numbers right out for the period because they're going to be the same no matter which option we choose for purchase. And since we put less than 20% down, we also have PMI as part of our expenses that we wouldn't have on the cash purchase. Let's do one more scenario, option three, where we put 20% down and we avoid the PMI factor. Everything else being equal. Next, why do people invest in real estate? Because it appreciates in value. It's an investment. So let's look up real estate market appreciation in this zip code. This is where it gets a little tricky because very quickly we can see several resources giving several answers. One of them says that 3.7% was the rise last year. Another says it was 12.8%, but we know that the last few years have been far from normal in any aspect of the world. So another resource says that for the 30-year average, 5.4% has been the growth. So let's just use that. So we had the 5.4% growth in home value over these 30 years for each of the options. Now you notice we added the appreciation of value in the home to all three options, regardless of how much we owed on the house in each case. Right? That's a really important concept that sometimes escapes people. In any of the cases above, does the loan scenario affect our ability to live in the house and enjoy it? No. Does it affect our ability to benefit from the growth in value of the home? No. Understand this, regardless of whether you own 5% of the house or 95% of the house, if you own the house, you still get to live in it and you still get to enjoy the benefit of appreciation in its value. I, like many other people, was raised with the well-intended advice of don't carry debt, pay off your house early. And I fell into that trap. And so when I had my first house, I refinanced it for a shorter term of 15 years and thought I was being smart by doing so. But then because of other things, I had to move and I ended up losing money as a result, and turned out I would have been better to just keep renting the house I had in the first place. So don't fall into the traps. Don't blindly accept advice. Do the math and determine what is really the smartest decision for your situation. Before we dive into the details, let's look at some other high-level items. Now, we talked about supply in one of the other videos, and that even though one option may be the best option, supply can limit that. So if we don't have $350,000 to go spend on day one, that's not an option for us. But for the purpose of deciding which approach is the best, we're going to just assume that we have all the money on day one to see which is the smarter approach. So for option one, we take the whole bucket of money and we spend it on the house, but for option 2 and 3, we don't need all that money on day one. So what we're going to do is take the balance and we're going to invest that, and we're going to benefit from growth on that money over the term of the loan. In order to estimate our growth potential on that balance, what we'll use is the S&P index average growth of 10.26%. And even though it affects all three because we own the home, I'm going to add a few painful dollars of home repair costs over the course of ownership as well. The other factor here, which is a big one, is tax deductions. Now, all three options allow the same tax benefit for deductions on property taxes, but each one has an individual benefit for taxes in terms of deduction for mortgage, insurance, and interest paid. We'll just use 24% as a tax rate in this bracket. When I ran the numbers, something didn't look right, and I realized the mistake I made was that I hadn't considered the money is still coming in to make payments on the bottom two options. So to make it fair, I had to consider that same amount of money coming in to be able to invest for option one as well. And this is where it's very important to think real carefully and make sure that you're doing fair comparisons. Now, after we lay in the formulas, put in the proper inputs, put in our estimates for rates and everything, we now let Excel do the math, and this tells us which one is truly the most beneficial for us. Is that the one you thought it would be? Again, you may not have the cash to do option one in the first place. As with any of these examples, you have to plug in your own numbers to really see what's best for you. But this gives you an idea of the real impact of looking at the various ways to buy a house and what that impact can be, especially over the course of a loan. Now that we've established the purchase options, let's add another factor of renting, because this is a very common choice people have to make, is do I rent or do I buy? So we had option 4, and in this area for this type of a house, what I'm told is that $2,900 per month is a going rate for rental. If we lay that out, we'll put 5.4% as a growth or inflation factor for that rent based on the real estate growth numbers that we looked up earlier. There's no PMI or property taxes in this case, but there's also no appreciation and growth of the property. Let's say we're in the more common scenario of probably not having the full amount of cash to buy the house or even to put the 20% down. But if we're thinking about renting, we're probably in an income range where maybe we only have the 5%. So if we look at just those two without having a bunch of cash to invest separately, what does that look like for us? And this, like many decisions, have an inflection point. So you can see in this case, at year 3, the inflection point where it changes from one decision goes from good to bad and the other one vice versa. So this helps us make the decision based on timing. If we're going to stay there less than 3 years, we might decide one way. If we're going to stay there longer than 3 years, we think, then we'll go the other way. I recently found myself in even another type of situation where I now own a house, I don't have it paid off, and I'm thinking about buying a different property to live in. And so the question is, do I sell this house and invest the money in equity that I have, or would it be smarter to keep this place, rent it out, and hang on to it? Now, even my mortgage financial guy was asking the question, why don't you just sell the house and invest that money? So I thought the only way to really get the right answer is to run the numbers and determine it that way. We can use the same basic decision-making process, we just structured a little bit differently. My situation was such that I had about $80,000 in equity in the house. I'd had it for a while, but what I'd recently done was refinance the house to not only lower my interest rate, but I also pulled a bunch of equity out of the house that it appreciated and I'd paid off, pulling that money out to pay off the 911 Turbo in the garage. That allowed me to eliminate the monthly ridiculous payment on that car, consolidate all my debt into one place through the house, spread it out over the time together, and lower my monthly expenses, as well as the interest rate on the money that I was paying on the car. So it had multiple benefits. For me to outright sell the house, let's use that as option one. And in that case, I would be pulling the $80,000 out of the house, and I would be investing that for, let's say, the remainder of a 28-year period on the loan. Option two would be that I keep the house and rent it out. So I still have mortgage and all the costs. I still have the growth in value in the house. I have income now from the renters, and that grows over time. I still have the expenses and everything associated with upkeep. I now also have a property manager fee that I have to pay, and I have income tax on the rental income. The other thing happening here is that I'm continuing to build growth on the full value of the house using the bank's money to own the house, and at the same time I'm paying down the loan, which means I'm building equity, and I'm doing that technically with the renter's money that they're paying me. So I'm building all this value with other people's money. Yes, I'm just simplifying some of these values as they change over the course of the loan with a linear relation instead of an actual formula for the loan. I just want to simplify things to get the point across, but it's going to be close enough for approximating what we're looking at here. And when you look at the two results, here we have another inflection point, this time at 12 years. So as long as that's past my expected lifespan, I would be better to keep the house and rent it out. Again, this is why it's so important to run your own numbers and not just listen to one person or another, because each scenario is different, and a lot of what we internalize about pay it off early and don't have debt is not always the smart choice. What we said in one of the earlier videos when we were talking about short and long-term view is that 3 years is the payoff period we kind of want to focus on. Real estate is unique though. When was the last time that you knew somebody that actually owned a property for the full 30 years? Timing is a big deal in these decisions. What's the risk you're going to leave? If you do leave, would it be smarter to rent the house out versus sell it? What if you need the money in equity in the house to put a down payment on your next house? You may not have that option because of supply constraints. Now I'm condensing the entire concept of real estate investment into one short video. So it's not going to cover everything. There's a whole lot more variables that can exist, not just about the timing, but the risk of moving, the supply of money that you may have. You may not use a 30-year fixed loan. You may be eligible for a VA or an FHA loan or some other kind of loan product. You might be in a position where you have to spend a certain amount of money because of a previous sale, or you get penalized by taxes. Or you may be in a situation where you're near retirement and you may be doing a reverse mortgage. What I'm trying to reinforce here is that no matter what your situation is, you use casual sense and you follow the process. You establish the options, you research the numbers, you do the math, and you make the smartest decision you can based on the information you have at your fingertips. And that is the key to any good decision-making process. If you haven't done so, please click the link below to subscribe to the channel, click the little bell for notifications when new videos come out, and check out the YCC store for any merch you might like, and let's use casual sense.